Now, we are moments away from the Fed's decision on interest rates. Wall Street widely expecting a 25 basis point hike. And take a look at where the major averages are ahead of this announcement. You're looking at not too far from the flat line for all three. The Dow up just about 45 points. S&P up about 1/3%. The NASDAQ, the leader of the three, Diane, up just about 0.5%. Essentially, though, in a holding pattern ahead of these results.
Yeah, it's been choppy trading all day today. We saw some fluctuations throughout the day. Mixed markets earlier in the session, now slightly higher. You tend to see pretty much a narrow range ahead of a Fed decision. Even right after the decision occurs, you tend to see trading in a narrow range, typically until the press conference. Then you may see some more volatility within the markets. I mean, you're seeing a little bit of a safety play ahead of the Fed decision today. I mean, you're seeing some moves in gold, silver, as markets just wait for the latest Fed speak. As you mentioned, the expectation is for 25 basis point. What would be surprising is if we see a pause. There was previously talk of a potential pause. Now, that's not really expected to happen generally in terms of the consensus view, Shauna.
Yeah, certainly not. When you take a look at the CME Fed Fund futures right now, about an 86% chance, that's what traders are pricing in right now, of a 25 basis point hike. You mentioned the defensive setup here ahead of this announcement that we'll get in just about 25 seconds. The defensive plays are leading today's action. You have real estate, utilities, healthcare among the outperformers by sector. We also know regional banks, they have been under a tremendous amount of pressure this week with the collapse of First Republic Bank. We are seeing some recouping of those recent losses here. The regional banking ETF, KRE, that is rebounding today. Also, some of the names that were beaten down the worst, those names are in the green. All right, the Fed decision is out. Let's get down to Jennifer Schonberger. Jen.
Rate hike. The Federal Reserve raising its benchmark interest rate to a new range of 5 to 5.25%. That's a 1/4 percentage point, and leaving the door open for future rate hikes, saying that future rate hikes will be contingent on the impact of previous rate hikes on the economy, as well as economic and financial developments. Now, officials deleted key language from that March policy statement that read that the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that's sufficiently restrictive. Again, they deleted that. Instead, officials saying, quote, in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. All this because Fed officials still view inflation as, quote, elevated and say they are highly attentive to inflation risks. They characterize the job market as still, quote, robust. Now, in the wake of the most latest bank failure, First Republic, officials say that the banking system remains sound and resilient. They said that tighter credit conditions will weigh on consumers, inflation, the economy, though the effects of that remain uncertain. Now, this decision was unanimous. We will get more from Fed Chair Powell in less than 30 minutes' time. Back to you.
Jen, I have one quick follow-up question for you. As you mentioned, the door seems to be open to the potential for more rate hikes. There had been the expectation leading up into today's move that there would potentially be a pause after today with regard to expectations for the terminal rate to come in between 5 to 5.25%. We're basically there now. Is there anything else that stands out in the statement that is surprising?
I think that's the biggest takeaway there. That was the biggest change, the fact that they are really keeping their options open at this juncture. Clearly, they still view inflation as sticky. Yeah, I said there that they still say that they characterize the job market as, quote, robust. So it's clear that perhaps there could be more work to do, but perhaps they want to sit back a bit and see what the lag effect is here in terms of monetary policy that has already been done, seeing that filter through. They are obviously seeing tighter credit conditions. They say that in the statement. So the questions du jour for Chair Powell are, how much work do you see left to do here? And what are you seeing on the credit tightening front? And how is that influencing your outlook for setting monetary policy?
All right. Jennifer, we'll certainly continue to keep parsing this, and we'll get back to you later in the show.